Something strange is happening in global finance right now. Stock markets are shaky, gold prices are hitting record highs, and major investors are quietly pulling money out of banks. But the reason behind all of it isn't being talked about enough. It's called private credit, and it's quietly becoming one of the biggest financial risks in the world. Some experts are even calling it the shadow banking bubble that could trigger the next financial crisis. Let's start with what private credit actually is. When you think of lending, you probably think of banks institutions like JP Morgan, Wells Fargo, or your local bank giving out business loans. But over the past few years, a new type of lending has taken over: loans made by private funds, not banks. These are hedge funds, private equity firms, and asset managers lending billions directly to companies. No regulation, no deposit insurance, no public scrutiny. It's fast, flexible, and for investors it's been incredibly profitable. But that's also what makes it so dangerous. Private credit has grown from a small niche market worth around $300 billion a decade ago to over $2.5 trillion today. That's larger than the entire high-yield bond market. And here's the crazy part: most of this money is loaned to companies that can't get financing from regular banks, companies that are too risky or too indebted for traditional lenders. Now, this might sound familiar because it's exactly what happened before 2008. Back then, risky mortgages were being handed out to people who couldn't afford them. Today, risky loans are being handed out to companies that might not survive a slowdown. And the difference is this time it's happening outside the banking system. So what's driving this boom? It all comes down to interest rates. When central banks raised rates to fight inflation, borrowing became expensive. Banks became cautious. They tightened lending standards, especially for small and mid-sized businesses. But those businesses still needed cash, and private lenders stepped in to fill the gap. It looked like a perfect match. Investors got high returns, companies got funding, and no one was asking too many questions. But now that rates have stayed high for so long, cracks are starting to appear. Let's look at what's happening. Companies that borrowed at low rates during the pandemic are now struggling to refinance their loans. Imagine having a loan at 4% suddenly jump to 10%. For some firms, that's enough to wipe out all profits or push them into default. And here's the scary part: when those defaults happen, there's no safety net. Private credit funds don't have access to central bank liquidity. They don't have deposit insurance. If borrowers can't pay, those losses go straight to investors, pension funds, endowments, and wealthy individuals. That means a big chain reaction is possible. Because remember, this market is deeply connected. Private equity firms own the same companies that private credit funds are lending to. So if one side falls, the other side collapses too. And that brings us to the stock market. Over the past few weeks, we've seen regional bank shares take a hit again. Why? Because banks still have exposure to parts of this credit cycle, especially in commercial real estate and small business lending. If private credit firms start facing losses, banks could see deposit withdrawals, liquidity stress, and valuation drops. Investors are already sensing it. They're moving money into gold, government bonds, and money market funds. Exactly what happens when fear enters the market. The IMF's latest Global Financial Stability Report even flagged this as one of the top global risks for 2025. They warned that private credit markets have grown rapidly with limited transparency, posing potential systemic risks. Translation: nobody really knows where the losses are, and that is the most dangerous kind of risk. The Reserve Bank of Australia echoed the same warning earlier this month. They said that financial stability risks remain elevated because of stretched valuations and vulnerabilities in non-bank financial institutions. Non-bank institutions, that's exactly what private credit is. Even major banks like JP Morgan and Citi are quietly preparing for impact. Their analysts have been trimming exposure to leveraged loans and riskier corporate debt, and on Wall Street, the tone has shifted from greed to caution. Let's break down what this means for everyday investors. First, the risk has moved out of sight. Because private credit operates in the shadows, it doesn't show up in normal economic data until it's too late. If defaults rise, it could hit pension funds, insurance companies, and high net worth portfolios long before regulators even realize what's happening. Second, the contagion risk is real. Private credit isn't isolated. It connects to real estate, small business lending, and even the stock market through leveraged buyouts. A wave of defaults could easily ripple into listed markets, causing sell-offs and liquidity shortages. Third, this could affect job markets. Many of these loans fund small and mid-sized businesses, companies that employ millions. If they start cutting costs or closing down, unemployment could spike. That in turn affects spending, demand, and eventually GDP. So what happens next? There are two possible scenarios. In the best case, central banks manage a soft landing. Rates slowly come down, refinancing becomes easier, and the economy stabilizes before defaults get out of hand. The private credit market takes a hit, but nothing breaks. In the worst case, rates stay high for too long. Borrowers begin to fall behind on payments, funds face redemption pressures, and investors rush for the exits that could force widespread selling not just in credit but across stocks, bonds, and real estate. And because this entire system is opaque, no one knows who's holding the ticking bomb. Sound familiar? It should. That's what made 2008 so dangerous, not just the bad loans, but the hidden leverage and lack of transparency. And this time, it's repeating on a different stage. But here's the twist, there's also opportunity. Whenever financial stress builds up, capital eventually flows to safer, stronger players. That means large banks with solid balance sheets or private funds that manage risk carefully could emerge stronger. Investors who understand where the real risk lies could also find bargains in undervalued sectors once the panic fades. For example, gold is already breaking records because it thrives when confidence falls. U.S. Treasuries, which were ignored for years, are suddenly in demand again, and cash, the most boring asset of all, has become powerful once more. So what should you take away from all of this? Private credit isn't evil. It fills a gap that the traditional system can't. But when trillions of dollars move outside the banking system without regulation, without transparency, and without safety nets, it creates invisible fault lines. And those cracks are beginning to show. The next few months will be critical. If inflation cools and central banks start cutting rates, the bubble may deflate slowly. But if rates stay high or another shock hits the system, we could see major corrections, first in private markets, then in public ones. Right now, the best move isn't to panic, it's to stay informed. Watch what the central banks say. Look at credit spreads, bond yields, and fund redemptions. Those are the early warning signs, because the next financial crisis won't look like 2008. It won't start in housing. It'll start quietly, in private credit, in deals no one sees, with losses no one reports until it's too late. And when that happens, it won't just be about Wall Street. It'll ripple across savings, pensions, jobs, and confidence, everything that makes the economy tick. This is the hidden risk shaping 2025. The question isn't if it bursts, it's when.